Welcome everybody, it's the Market Sniper. Yes, we're going to be talking to you about both the oil and, more importantly, the silver market. These damn silver bull guys, they cry wolf non-stop. That's right, are the silver bulls the biggest cry wolf guys of the lot? What's going on in the silver market? Let's get into that. And to do that, first, I'm going to start with you in the chart somewhere else. The oil market. Yep. We've also made calls on the oil market, by the way, so we're kind of merging the two into the same vid. But what we have said as we look at the charts over here is that you are facing a reversal to the upside now in the energies markets after this rather soft period. So in the blue corner, you have your left shoulder. Let's do it in blue. Why don't you? Fat Koki, you see him there all the way up and into that key interaction with 8250. Then the complexity that's very hard to spot, which also included those production cuts. There's the gap for you right there and the gap line as you can see it. And that's in red. So you can see it from that 8250, kind of a little bit of a flag in there as you can see it. Then a real harsh throwdown, bang, down to here, ripping back up, and it kissed it over there. So you sometimes get what we refer to as a W head. So it is a complex head. It comes up and then it's smashed back down again. So even with the production cuts, we smashed back down. We were warning about during that period that there was a softness to the energies, but it didn't continue further, it has to be said, and it started to tighten. And this is a more chilled, rounded bottom. This is a very spiky left glute. This is a more rounded, and that points often to a bit more basing and a thawing of the volatility and the slapping around and the vicious whiplash that the market was getting. Overall, you started to make your way back up. You had a little pause and resistant pullback when you got into the zone where the gap was. That was your gap zone. You'd already closed it once to the downside. Then you went up through, and then you interacted again for the third time now since the beginning of the pattern. So you broke into the pattern to form the left shoulder. This is the third interaction. We call it armpit one. That was your W head point, which is usually in the middle, and then point two, which is armpit two. What did you then get? In the blue corner, only this time it's the other side of the ring, is of course the right shoulder, I think it is. Left, right, yeah. Ladies left, ladies right, maybe man's right. Who knows? Falling wedge, I always get that with my missus when she's driving. I mean, do you mean real right or do you mean ladies right? I'm going to get into trouble now. Hit the like button if I'm a cheeky bastard. If you're a woman, tell me off properly in the comments. Tell me why I am such a jerk. Okay, anyway, so there we go. Falling wedge. In you go, you break out of it, and then you come back up, and then you get to the neckline over there. And this has since been a break, and we've called for the 106.9. That's going to be $107 in oil. It's going to be a pretty decent RH2. Don't forget, we gave you the pullback here and said that's going to be around about your top at about 129. Go and look at that case study on our website of both the collapse and the rally if you like to see how we've implemented and watched on oil. We don't always get everything always right, but that was a good run of calls in that one, and it shows the method, by the way, the real method, the understanding of complex head and shoulders that you too can learn and watch implemented with us, with HVF method, understanding it with all the videos so that you can deep dive to fully get it and see us apply it in practical markets so that we can manufacture macro trades, medium long-term trades, and if you want to get into the lower time frames, you can even generate low time frame trades. So this move since this break fairly firm on oil. But hold on, this is a silver video and it's got a silver title. Why are we talking about oil? Well, a couple of things. Look at me, look at me, look at me. Digging holes in the ground takes a hell of a lot of energy. Bringing rocks up from deep down to the surface to crush them, to look for things, takes a whole bunch of energy. That is a lot of gravity that has to get fought against. There's a lot of tonnage that has to get moved around. There are real costs, and energy is kind of expensive. And this is an example of energy getting more expensive. And how has the relationship for oil and silver truly panned out? So here I've gone back, the candlestick charts over here is your oil price. And I've gone back to about 97. That was the run-in into the 2000s. That was a pretty poor period for metals, by the way. And that is the blue line, which is silver. So blue is silver, and the candlestick is, in actual fact, the oil market. So you will see that there's some interesting aspects. Oil generally, during the financialization of everything period and the low period for metals in the early millennium era, run up to the millennium and all of that, was actually generally outperforming a little bit. You can see oil over here. Let's go with the pink so it pops. And fat cokie again. So you can see oil was relatively more valued. If we took this as a base point, around about the 97 year as the beginning, oil again more valued. But you can clearly see the correlation. Now, obviously, it's not a one-to-one correlation because then they would be diametrically on top of each other. But you can see the high level of correlation. Bit of a run up in silver. Then silver created this little HVF. So I'm now drawing on the blue line. But you can see all during this period, oil was already leaking up and higher. Then when it finally was let go, silver had a major surge and played catch up. So you can see that there are leads and lags. Sometimes one leads, sometimes the other leads. Generally, oil has led, but that's not universally true in every major turning point. So here you can see oil was a bit higher, but then oil had a pullback and was much less. In actual fact, they were for a short period diametrically opposed. So oil was coming down, silver continued up, then silver had a little dip, and then at that point oil was going back up again. So there are spells where they can move in opposite direction, but generally they're short-lived, and one or the other reverts to what the other one is doing. In other words, silver began a strong up move and it started to comply along with oil. In this instance, oil, this was now the subprime element. Financialization of everything. Metals were very suppressed during that period. Real money, who needs real money? Create credit. Everything is awesome. And as a result, oil was benefiting from that. Lots of people buying new cars, energies, lots of cars, lots of everything that burns oil, products, plastics, packaging, everything. And you can see that silver turned earlier in this instance. So if I just put and draw a straight line, you can see the turning for oil came later. It was so cool to be buying everything and have so many cars, but it fell a lot harder. So it was far more consumption required to keep that oil price up that much, and it fell a lot more higher, and it got fluffy and it diverged a bit. In fact, in this instance, again, the bottom came earlier for silver. So you can see it's not universally true that every time silver will lead necessarily. My apologies, that oil will lead. Sometimes silver can lead. But generally, in time, they will all flow. Now, in the post subprime world, where everybody suddenly started to realize this debt thing and this money thing and this borrowing money into existence is a bit of a different game, you probably have a little bit more overperformance if you're taking the 97 as the base year, as I have done here, of silver. And so in the next run up, which brought us to the doorstep of the Ukraine-Russia potential conflict Mark 1, which they were warming up for you. You saw that actually silver overperformed, and in 2011 you got a $50 silver as part of that, and it was far outperforming the oil markets. But, as you say, second echo crash, and we went into what was a technical low. Actually, 2016 is the year that no one knows. That was such a difficult time. There was China had created so much heat in the economy, and they reached peak indebtedness, and you had the Shanghai Accord. Because it didn't affect Western nations so much, we were just hearing about China being the next big thing the whole time during this period from 2009 into 15, we didn't realize that they'd also built up a whole bunch of debt. So as a result, as China started to draw its horns in now and started to go into its own version of related debt crises and various other aspects, both silver and oil pulled down, but oil pulled down more so. Again, using this as a base year. Change this base year, the relative performances change. So that's where we're at. Then bounce along. We had the final capitulation of, you guessed it, this was ridiculously low, and clearly silver didn't fall as low, although it fell pretty hard. So now where are we now? You got the immense reflation of oil following the most ridiculous pricing that could have occurred due to a glut that was caused. And of course, everyone being locked down and killed the demand. Everyone needed a certain amount of revenue. Russia didn't cooperate with Saudi back then, as opposed to right now. And as a result, everyone wanted the same amount of money and was looking to get the same amount of money they needed to run their countries. So they just pumped more oil, and you got a glut in an environment where there was reduced demand, aka the lockdown. However, the reflation was very, very strong. And while silver did rally reasonably itself, oil in percentage terms certainly did a bigger job of it. Then down into here, a bit of a crash. And you can see that oil was still upside, correcting from its crash. So there was a sustained period of dichotomy, let's say, in terms of choice of words, in terms of correlation and performance during that. You got into the low here, and silver had been going down for an extended period. I think it meets Wall Street Bets high. It possibly was here. It might have also been there. I'm not entirely sure. But you got an intraday high, I think around the 30s, 32, 33. Since then, you dropped all the way back down. I think it was around 19. During that period, oil was still going up because it had been so suppressed relatively during this period. So it had an extended bull. Geometrically speaking, the greater the crash, the bigger the pump. The greater the pump, the bigger the crash. There is a natural law. The leverage that has to be unwound that was put on in one direction has to be unwound in the same direction. So there's a symmetry to this. So this is what's really interesting about chart watching. So what has happened since? Now that the sort of it's 3 years ago, March 2020. It's in fact more than 3 years ago. But the effects of it ran for all of 2020 and into 21 and probably tailed in other parts of the year. But what's happened is we've had a divergence of performance. So oil then corrected, and I think that was part of the fluff of blowing off over here. So it probably needed from about these levels to do what silver did, come down and sideways a little bit, but it continued up with the momentum that was going on during that time. So now we are getting oil in an upward market, and I showed you that it's knocking on the door of $89. That's WTI in that first chart just before this. And during that period, we're actually getting a bit of a toppy, regular ups and hard slams, and that has actually run that low now. And we'd said, hey, we're bouncing on that 78, going to the 80 on the gold-silver ratio. When that 78 breaks, that could be a seminal moment. We had an opportunity where it could have happened when we gave everybody a heads up, and it didn't. It did exactly the opposite and rallied. So what tends to happen is when you have many, many taps on the floor, it takes a lot longer for the break, but when the break occurs, it falls harder. So we'll be getting to the gold-silver ratio in a minute. But the key thing here is to highlight to you that oil is in fact heading up, 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 and that the blue line of silver is actually heading down at the same time. Now, one of two things will happen, beautiful people. Oil will continue to grind its way higher, and silver will eventually stop going down and will start to go up too. Or we have a demand destroying event, and in fact oil reverses, doesn't make its 106 target, or maybe it just does and then finishes and comes down, and all during that time silver is kind of flat or downish and diverging for a while. But post the target of 106.9 or $107 for oil, oil comes down hard, and as a result, they both go down a little bit together. Or potentially, oil takes its time about getting to 107, keeps going up over an extended period, and silver turns and starts going up too. That is the key moment that many of the silver bulls will be hoping for. So this is just to highlight the fact that energies and silver do require a certain degree of correlation generally. Why? Commodities and of course dollar effect, which is pretty common. When people are unsure about the dollar, they move into physical things, and of course the costs of things like oil go up. By the way, yesterday you got data. Remember everybody telling you inflation dead, inflation dead? Here is your data. Expected CPI, core CPI was 0.2, came in 50% bigger at 0.3. CPI month on month was as expected. CPI year on year expected 3.6, came in at 3.7. So CPI is coming in stronger than expectations, but inflation is beaten. No, it comes in waves and surges. There is buffeting, there's year-on-year comparisons. After you've had a big surge, you obviously got basing effects from a much higher level. And is the economy growing and doing awesome in that environment? Expected minus 0.2% GDP contraction. Actual GDP contraction is far higher. Now, this is a perfect set of statistics for our hyper stagflation scenario that we continue to tell you about. Inflation coming in higher than in expectations, growth coming in lower than expectations. So people have never felt so poor and prices have never felt so expensive, and it isn't getting any better. They're going higher and people are feeling poorer. This is exactly the reverse Goldilocks effect of that chief criminal of the Federal Reserve, Alan Greenspan, that was made a hero for pumping liquidity from when he came in 96 all the way through, in fact it was 87, my apologies, all the way through to 96 when he preached irrational exuberance whilst the market was made to pump on anyway. And he never upped the rate sufficiently and eventually built up and stored up all the liquidity experiments for our friend Shlomo Bernanke and Yellen and all the subsequent guys to deal with the post hangover, which they've continued to deal with in a very similar way that Mr. Greenspan did. But anyway, there's hyper stagflation in stats brought to you by us. We expect unders on GDP, overs on CPI. This notion that you've won on the inflationary war is not going to be helping. By the way, there's a lag in these stats. The oil price is going up now. The recent increases of those same oil prices will not be baked into those inflation statistics. They will be coming in the future ones, and they are higher, obviously, and at a higher level. So this is really, really important, and I want you guys to understand. You're going to get continual shunts of inflation coming back into the system. So at the moment, when you are having a destroyed consumer, so let's go to our gold-silver ratio and talk about this. So last time we spoke to you, it was over here, and we're saying, hey, guys, watch out, you're getting close to, let's put it on the log scale that it's needed, and I'll just remind you of the big picture. Let's go to weekly so that you can remember this for those that might be watching our videos for the first time. We're in a larger broadening structure. We are waiting for this dotted red line to be broken to the downside, a basing ascending grind line. Many tests means the eventual breakdown will be violent, which we've continued to preach. And this was a possible break. That's why we did the video, and it turned out, no, it's been rejected again. Can I also point out that each rally, this was the first rally, that's from long ago, but each subsequent rally has been smaller and shorter. This was close to being similar, and this one's also fairly close to being similar, and it hasn't topped out yet. Now, if we were to run the tops of any of these, then we no longer have these descending highs across all these impulses. That is leading to a potential squeeze, which we feel in the longer run would eventually have that downside break. But it could be a requirement that it's going to have to be post some demand destroying event, a destroyed economy, and once the QE comes back in again. And we might be higher for longer, more inflation. And the notion of possible interest rate hikes because of high CPI tends to work against the likes of Bitcoin, the likes of gold and silver. They don't officially pay any interest. They are capital preservation tools. So the notion that your debt's interest rates will get higher and that the negative real interest rates will get less, which is essentially the devaluation of debt by default, a proxy default, means that gold and silver will not go up as fast, and hence why you might be getting selling offs. So it points to the need for further high interest rates, but also it points to the pain that the general economy is, and that is caught between the devil and the deep blue sea, and that is the notion of hyperstagflation, which is worse than what the 70s had because the debt levels are higher. More of their global economies have been synchronized into a hyper-indebted state where you essentially have one central bank policy that is universal. They have all been coerced into doing exactly as the Fed has done, whether that is by conspiracy or any other means. That is just the most dominant Federal Reserve with a great-ass military that can threaten you and say, it's time you did the same as us. As they did recently with the Japanese post the World War II, for example, and all the way through the 80s and 90s. Look out for our interview with Professor Yes, Professor Richard Werner of Princes of the Yen. Check it out. It'll be coming out probably this weekend. I think you're going to enjoy that, and a very interesting book as well. Anyway, so gold-silver ratio, this is where we are. It's on the bigger time frames. Let's take it into the lower time frames again and show you how it's all looking. Here you have the daily. You see, this little bit was a topping, and it surged up today, but it's looking a little more tight. It's getting a tiny bit more pensive as it gets here, but nonetheless, it still has to be said that it was a very robust upward move. Hence why I named this video, Are We All Cry Wolfers That the Silver Bull is Coming, only for it to turn out that you're getting teased and teased for longer. Now, what tends to happen on the lower time frames, guys, is that you get a structure of squaring up. We call this a squaring up. So you can see over here, you start to have an actual price level. This is a grinding line that is actually changing values as it ascends. But after a while, when you get to a point where you're getting ready to fail, you start to do what I refer to as squaring up. And this is why this is such an interesting point for us. So 80 is the blue line there for the level, and you can see lows, lows, and lows. So you have an entrapment box of lows there. You have it pretty much catches that, and you had a similar level, and that's when it feigned and looked like it was about to let go. Hence why we said possible, the big move with real momentum coming. But if it stands and doesn't, it will reverse. So it's going to do one of two things. It was a real fork. It's not just going to hang out there. It's going to either spill or it's going to reverse firmly. Now, the one thing that is surprising me a tiny bit is that it's kind of robust. It's going almost as high as, even if this was the high and it turns down from now, it's getting almost as high as the previous one. And it was quite reasonable momentum as it was here. So the momentum, the zipping is quite big between it. There's quite some thrashing. Even though it's a tight range, there's quite a bit of thrashability going on here. And if this becomes more of a ledge and you come a little bit higher in there, you know, we end up more in a ledge. It's less, it's not bearish, but this is more bearish when you can actually get a squeeze along the top. So the key elements that's getting interesting is this squaring up zone, which is between the 78 and the 80. And we need to see if the 85 is again going to prove to be resistance. The 85 through roughly, what is that, 87. That's maybe a bit far, 85, 86 zone, roughly where our funnel was from that legacy HVF. So you kind of have your zone very much determined like that. Do we turn around? If we turn around and come down, this dotted line is getting higher each time. Will you dip through it a little deeper like you did here, and will it eventually let go? One of these events, one of two things have to happen. This ledge won't be maintained with its ceiling, its hard ceiling and its soft ceiling, and its hard floor and soft floor won't be maintained forever. One of them is going to let go. Overall, our opinion is always biased to the downside is eventually going to be the one that fails. However, were we to get a demand destroying event, the stock market crashes, debt, repo markets, banks, yada, 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 fish base, create the, the whole fear and loathing deflationary element, you could actually get a spike out the top. So there is that risk. You could get a spike out the top for a bigger move on the gold silver ratio, which could see silver sell off a little bit more. If we are to get something that is what I would describe as adverse economic events in the general category, which could also involve reset topics that I'll not get into now, but it's, just choose your disease of choice, your pandemic of choice, your lockdown of choice, climate, whatever, and other related topics that I'm not going to dig too deep in this video. So overall, that is one risk, that the gold silver ratio could break out to the top side. However, if we start to lose momentum in reverse, the sell-off could again be steep. Just about all the sell-offs have been pretty brutal as well, it must be said, like that and like that. And as a result, were we to get something again and it to come back down, I would expect it to be no different. But the difference is this basing ascending grind line is getting higher. At some point, it'll have to either bounce higher, or if it comes down to the same hard floor, it'll eventually realize that it's taken this basing ascending grind line out quite substantially and might spill a little further. That could be the trap door floor breaking, which will mean that silver is starting to overperform again, both gold, which means they're probably both going up, just silver more so, and you might get the likes, if we go back to our oil silver chart, the point at which there's oil alone and oil silver, the point at which this blue line will start to show a bit of better upside. Or, as I've said, the possibility that oil stops going up and doesn't make targets. So they're either going to have to diverge for a rather long time. It doesn't happen very often that they diverge for a rather long time, or one of them is going to have to come and meet the other one and change direction. So the question is, there's a couple of options of that. It doesn't all mean that it's bullish. A demand destroying event could stop oil in its tracks, but I'm not so sure. I think at some point the gold-silver ratio comes around. So here we are with silver. And here, there's two scenarios that we look at. If we take this overall as what I'd describe as a fairly complex first impulse, you've actually had smaller versions here. So this feels like a little bit of a slap in the face, that sell-off period. Let's just put the eye on here. You're going to see all the draws that we've done. We've highlighted that this 22 level was very seminal on the left shoulder of this green head and shoulder. In fact, let me go to the top line first. Let's do this properly and do macro to micro. We will go weekly, I think maybe a bit better, and we'll steal a bit more real estate. There we go. So the big overall continuation pattern theory goes like this. The extreme up leg of the silver from the whole COVID related lows was bullish, and it was the beginning of a new bull trend. Okay, so we anticipate continuation. That said, this is still a very big continuation pattern as it stands. It's a broadening structure. It's what we'd call a megaphone on a bull pole. We would split it and we'd say, yep, you can see a lot of in-betweener swings making the splitter around there, such as there and there. And our anticipation is at some point, this capping descending grind line is actually broken and you break to the upside. Further to that, on a slightly smaller scale, you'll also notice the greened out area, which I'll maybe just drop down to the 3-day so we can just have that in scene. That is a potential head and shoulders. So something I want to remind you of, the diagram is not the territory. So in terms of inverted head and shoulders, the diagram just looks very simply like that, which I've drawn in the green for you. However, you do get a high degree of complexity. So instead of the green area, this shouldering was formed, and this is the complexity that we refer to, with lots of zigs and zags. You see the little red circles, which are the repeated interactions with a 22 level. Over here, there was even one there, and we've drawn that all the way through, and you got very close to it over here. Now, when you have a complex left shoulder, it's like an animal with spots. If the one part of the body of the animal has spots, the tail, is quite likely the rest of the body has spots. So it's telling you to expect a complex right shoulder and a complex head. In other words, it's a thrashy pattern. It's not going to be exactly like the diagram. There's going to be deviations, and you can see in the head there was a little dipsel and a little bit of zig and zagging before you hammered out that final low like that. And then you had quite a big deviation there before you came around. That is head. That was left shoulder over there, Greek style writing. Woohoo, fat Koki, so cool. Okay, so now we are in the business end that we are interested in right now. And again, you've got complexity. I could, of course, highlight that that had a little bit of a zig and a zag in it. That's went up and had a little bit of a zig and a zag. And now we are still zigging and zagging. And you can see, if you count the number of zigs and zags, you can be wrong a lot of times before you get it. There's 1, 2, 3, 4, just in this right shoulder, there were 5 downside visits before it went back up to meet the neckline that we've chosen here at the $26 mark. So that's a seminally interesting $26 mark. Just as a quick reminder, we'll go and revisit those targets because I'll get a lot of comments. So what are you calling for and when's it going to happen and all of this stuff? Listen to the videos, watch the stuff. We tell you all the information, but we'll recap it today. So we are in a downswing period of that, but you don't want to get too confident that that's just going to keep going down because history has shown you that if you called a bear run there, it rallied. If you called a bear run there, it rallied. If you called a bear run there, it rallied. Apart from this period of the head where it dipped super low and things were pretty sketchy during that time, it's not looking really like it's going to do that again. I would imagine more ziggy and zaggy, but long run we head to 26, assuming oil continues up and we do not have a major macro globally synchronized economic event that is to the downside. But, you know, what can I say? We'll soon see. So let's have a look at this on a lower time frame. So we are moving into the right shoulder now. We're moving into the right shoulder of this greened out zone to give you more detail on this. So as we do that, we'll go daily first. Interestingly, you can see the volume has picked up now. This is on Oanda, so those things change and can pivot, but you can see quite a high increase in activity in the markets over here. It's quite ironic because part of this was during the August period, which is typically associated with the summer doldrums, and you sold off there, then you bounced. But now we are getting into back to work phase, and first we had the sell-off on that data, which is bad for inflation, could mean higher interest rates still to come. Okay, so I'm going to show you a little bit more on this. You can see we got a fractal of reversal this last low. That's what all those little scribbles are about. So I'm going to drop you in there. Are we going to get something similar? So I'm going to take the volume off now for now. Are we going to get something similar? You see that little left in the orange, curious head all the way up to the same neckline of 22.95. Then we got a little upside HVF in the right shoulder to up, and then off you went, and a final HVF that took those tops out beautifully. And since then you've been selling to off to the downside. Let's take that off. So you can see you did support temporarily on that neckline, and you paused for quite an extended period. So there was resistance to the selling in there, but eventually you broke both that and you said goodbye to the neckline. So that was a run of short-term support. The big question is, are you going to go lower than this guy over here, which is down at around 22.15, 22.26, sorry. So that spill was a little bit disorderly. You might rally up to into there, but you could still sell off more. You could go lower, and it's still part of the complexity. It will, however, if you did do that, it would spoil any notion of us having a volatility squeeze for the upside. So remember, we were talking and go a little bit higher time frames. Let's see if we can get 8 hours up there. We were talking about, is this going to potentially give us something that represents a compression, because we like that. Now, were this downside to run that, then you cease to have the rising baseline, or at least flat baseline. You'll just have the contraction across the highs, which is a squeeze, but you won't have the squeeze from the low. We need at least a horizontal level here, and if this continues for much longer. So we are at a key decision point, guys. This is a decision time. This almost needs to turn in the next few days into early half of next week. Otherwise, we're at a real risk that that level gets run. And if we run that level, the compression is gone. In other words, we do not have a squeeze structural pattern. There is also a risk, if we do have the demand destroying event, that the framing is different. This was all a harsh slap in the face, because this is a very big impulse. It's disproportional in terms of these two, and this structure drawn in a different color represents a zig and a zag. And I will highlight quite a lot is in favor of this case, because these sell-offs have been brutally harsh sell-offs, and this is almost faster and more furious. So what you could end up having is a minor bounce coming like that, and then a breakdown. And that would mean, certainly in terms of the shouldering period, you are now running that 22, or at least testing that 22, which was the support for the left shoulder, the first shoulder that I showed you that had all the complexity in it. So a break of that will point to quite a bearish set of circumstances were we to do that. If that turns out to be the weak rally high after a minor turn, that will point to a downside smash. Now this will probably be associated with oil ceasing to go up, or certainly slowing down, and oil pulling back. If oil turned around and started to sell off again, and there was this very negative macroeconomic environment, silver will continue to pull back a fair bit more. And it's quite possible that the current draw of that green reversal will be thrown out. So it's very important what happens next. Ideally for the bull scenario, which is not what I'm showing you here, I'm showing you the bear scenario, you need an early reversal. So that's your bear scenario that I'm showing you. Let's show you the bull scenario. For the bull scenario, let's do it in green. We'll stay with the fat Koki. For the bull scenario, we want to include all of that, and we want to see that like that. And despite this harsh sell-off that we're getting here, you'd want to see a violent return and a nice high move somewhere there, rejecting these levels. That's calling for a lot of bullish behavior, and it's not been seen just yet, so it remains to be seen if that's going to happen. And then we can go back to saying, okay, cool, we're getting continuation patterns just with a bit of a flat bottom, but we need that to get back up to the 23.9s, 24s, and going 25s. So that would be a bull version of what it takes. For me, it starts to become a very big problem if you run the low of this previous low. What is that value? And I would bias to the bear side then, and probably macroeconomic problems. 22.22. A lot of liquidity being sought and people liquidating. 22.22 you don't want to see. Where are we now? Not that far off, 22.61. So, you know, if you're a betting man, you're saying you're knocking on the door already. So there is a real case from being made that, again, the cry wolf silver bulls have been taunted and taunted only for not having made their break. Events and macroeconomics are caught up with them, and in fact you get a deval and you break down the other way to the downside. I would certainly say with any physical you have, that discount window should be utilized aggressively. Many people will say this is a legacy metal, it'll never amount to what it used to amount to in days gone by and things like that. People say this. It's always different this time until it isn't. And for those of you that have now seen the great hated industry of uranium now being really strong again and looking like it's going to outperform equities and many other things, you'll understand that nothing ever goes so far out of fashion that there's never any coming back. It just creates even larger buying opportunities in all of that. So I think I've covered it all from the gold silver ratio. We did get an alert on natural gas. That's quite ironic. It's happening right now. And because I introduced oil, and because I am talking to you about energies getting more expensive, and I'm reminding you that energy has to be utilized to dig holes in grounds to mine for gold, silver, or any other mining activity, especially in an environment where there is no ESG bankers prepared to do lending. It's hard to get funding. Things get real expensive like all of a sudden. So this is a real possibility that this will further make the case that energies are turning. Can I remind you, northern hemisphere is now going autumn. It's going to start getting cooler, and the demand and the seasonal demand for energy to keep properties warm, and Europe had an unnaturally warm winter and bought an absolute obscene amount of coal from South Africa because no buying from Russia, because Russia bad. Russia's so bad. He's so bad. Makes me want to be a Russian. Anyway, so because of all those things, there is a potential breakout. You can see we were speculating when that might occur some time ago, and it looks like that moment is coming. Left shoulder, basing out, neckline visit. We went with the 3. We adjusted this slightly. We went with a 3 being the key level. Such a logical round number. By the way, that will take you to around about 4.4 on natural gas. And my alerts are telling me the market is coming up. The market is coming up. The right shoulder, which is smaller and more slight than the first capitulation left shoulder. You can see it. You can see it. You can see it. So there you go. That happened while I was recording. You were meant to see this. Hit the like button if you like real-time updates from your friend, the Market Sniper. Don't forget, book a call to watch us implement potential market opportunities utilizing HVF method. Get the updates from me daily along with the information of how HVF is utilized with the real trade ideas. There's many trade ideas I'm afraid I can't share with you. Premium areas for premium trades. And you too can build wealth in reset season. You need to have money management so that you never take an outsized loss. You need to have, for example, on the money management side, your deepest stop could be down here on the right shoulder. Your entries could be anywhere here and your gain is there. That's decent, but you can optimize that to reduce the width of that risk, subsequently to get even bigger risk rewards, which allow you to trade a little bit larger without blowing risk money management rules. This is very useful. And there's also been some excellent equity trades, a lot of other things that we don't tend to discuss as much here on this channel that our community are potentially taking with regular webinars, updates, etc. So hit the like button and the share. Thank you for watching. I'll catch you next time. Silver is at its decision time. And as you saw, natural gas could be joining oil in a reversal for the upside. Are they going to diverge from silver going up while silver goes down? How long before one of them turns? That is the big question. Are we crying wolf again, that a real key moment has to happen soon for silver? Could there be a turning? It could be a very low risk entry, or is it just going to stay bad news? You tell me what you think is going to happen next in the comments at the end of this video. Thank you for watching and catch you again soon. Bye-bye. By the way, I want to thank you all for your purchases through the Pure Gold link in the details below. We've had over 7-digit sum of investors from all over the world putting small amounts, monthly amounts, big sums, you name it, gold, silver, platinum, you're buying it all, bars, coins from different jurisdictions, you're buying it all. There's not been a single complaint, by the way. Everybody is loving it and going back. The guys talk to you and they offer you an absolute money back guarantee, and they deliver virtually anywhere in the world except Nigeria. Sorry, my Nigerian fans, with very few exceptions, then one or two more. They will clarify that with you. But States, Canada, you name it, Southern Africa, UK, continental Europe, they do it everywhere. Really secure. Every package arrives. It's awesome. So thank you for that. And remember, if the silver is turning, this could be an amazing time to accumulate physical silver, and it's never bad to have a little bit of gold, and in any denominations you can afford. Don't forget also, if you're really battling and you haven't got money and you've only got $25 a month, go and accumulate on the bullion vault below, internet gold and silver, and when you get up to $1,000 you can cash it out and purchase actual coins, bars, bullion, silver, and gold. I particularly like silver. I think it's going to do really, really well. And I think the opportunity to accumulate with the help of the Pure Gold guys is definitely there. Thank you again, and we'll speak to you all again soon.